What's good, everybody? Welcome to FX Agents. My name is Ari Jones, and this channel is where I will be documenting my journey in the financial markets. Before we get into today's video, be sure to like, comment, subscribe, standard procedure, and don't forget to share this video with your friends or anyone who is interested in knowing what exactly is Forex. And before I waste any further time, let me just get right into the video. So before I get into the video, the link to this document will be on my Telegram group. You could just click the link in the description and you will have access to this document, which I'll post it on my Telegram group or my Telegram group for free. You know what I'm saying? So cut the chase. What is Forex? Who is Forex? Who trades Forex? And. So Forex is an abbreviation meaning foreign exchange or FX. It is a global market where people, companies, and institutions buy and sell currencies against each other. So it is a market where currencies compete against other currencies. You know what I'm saying? So in order for you to trade in the foreign exchange market, you have to trade currencies versus currencies. Currencies are always traded in pairs. You know what I'm saying? It's always one currency against the other currency. I hope I'm making sense. And don't forget to write down notes, guys. Please, I said please. So currencies are always traded in pairs. I did mention that. And the whole goal and the whole concept is to make profit through the changes in the exchange rate. You know what I'm saying? I'll explain that further as we carry on. And I'm going to make a practical example. Imagine you're in Johannesburg and want to travel to the US. You exchange South African rands for United States dollars. If the rand weakens later, or if the rand loses its value, your United States dollar will gain more value. You understand? Let me just make a practical example for you guys. So what I mean is that you want to travel to the United States of America, pardon me, and $1 is equivalent to let's say 15 rand. You get what I'm saying? And you want $100. So you have $100 in your account, I assume. We manifest in moves. And the rate is 15 rand. So times 15 should be equal to 1,500. And let's say you wake up tomorrow and the dollar has gained its power to the rand, and now the dollar is equal to 17 rand. Therefore, you'd now be having 1,700. And the difference between these two is your profit. The difference is there for 200 rand, which is then your profit. You made this profit because the dollar gained power to the rand. So the exchange rate fluctuated. That's what I mean to say. So that's how you make money basically in the foreign exchange market, the Forex market. And we carry on. So how the Forex market actually works. You know what I'm saying? So the Forex market is a decentralized and over-the-counter type of market, meaning that currencies are traded in pairs, not just like stocks where you can just buy Tesla and you just buy shares from Tesla alone. In currencies, you can't just buy euros. You need to buy euros against what? So it's currency versus currency. You're bidding on that. I don't want to use that spot betting language here. This is azlali la. I-Forex le, azlali Forex. Ngicela ukuthi ish azlala. Anyways, what I mean to say is that the Forex market is traded in pairs, okay? And for you to be a participant in the foreign exchange market, you need to go via a broker. So a broker is like a middleman between you and the currency or the market. Yeah, you and the market, because you cannot access the market directly. You have to go through the broker. The same way you cannot access Tesla directly, you have to go through the stockbroker. The same way you cannot access shares at Shoprite directly, you'd have to go via the JSE. I hope I'm making sense. So for you to access the foreign exchange market, you have to go through a broker. Yes, I'll explain brokers maybe a little bit later. That's not important for now. What else you need to know about the foreign exchange market is that it is a market that is active 24 hours a day, and it is active for 5 days. So you're able to trade Monday, Tuesday, Wednesday, Thursday, and Friday for 24 hours. Yes, for 24 hours. So you're able to make money for 24 hours in a day. You know what I'm saying? Anyways, as we proceed, the foreign exchange market is the biggest market in the world, on planet Earth, because $7 trillion, lalel, $7 trillion every day is circulating in the market. And the question is, how much do you really need to change your life? Because you don't really need that $7 trillion. Just a young 1 million yana can sort you out. You get what I'm saying? So it is the largest market in the world, with plus $7 trillion circulating in the market daily, which means there's $7 trillion in the market for you to dopa for you to like access or whatever. And people who participate in Forex, who are these people? Who are the traders, or who are the participants in a foreign exchange market? So participants in a foreign exchange market are central banks, like the South African Reserve Bank, the Fed. There's commercial and investment banks, there's hedge funds and large institutions, and there's corporations, and then there's you and I, retail traders. You know, we out there with the big bosses, hey, so we're not bossing, but we are there because we also want a bite of that $7 trillion. You get what I'm saying? So yeah. So, but what you need to know is that retail traders only inject 5 to 6% of that $7 trillion. I mean, not dollars. Oh yeah, it is dollars. Retail traders participate only 5 to 6% of that 7 trillion USD. You hear what I'm saying? So we are at the bottom. But regardless of that, that 5% is a lot. It can change your life at an instant. You get what I'm saying? As we proceed. So how money is made? Money is made by buying and selling currencies against other currencies. To make a practical example, which I did before, where I explained that you holding United States dollars today and the dollar gains power, and the difference between the money you bought at and the money you sell at is your profit or your loss. Like I did explain before. Let's just go back so that you guys are following. Oh, my bad. This is exactly what I was saying. This is how you make your profit, basically. I'm not going to go over something I did go over and over again. But then, practically, for example, you trade the euro to the United States dollar, the euro being the base currency and the United States dollar being the code currency. If it rises from 1.0850 to 1.0950 and you sell it at that highest rate, and that's how you make your profit, by buying at a low rate and selling at a higher rate. It's basically simple. I hope you guys are still following. And the opposite when you're selling. When you're selling, you could sell at a high rate and you could buy back at a low rate. That is how you make your profit. You get what I'm saying? So you are basically bidding against currencies, yabo. For example, you're bidding that today the euro is gonna gain its power to the United States dollar, and therefore you are buying at that low rate or that current rate, and so the euro gains its power and you sell it back to the market. That's how you make your profit, basically. And profit and loss is measured in pips. I'll explain later what is a pip, what are pips, and. So a 0,0001 move is equivalent to 1 pip. Grasp that, it is important. I'll explain further what are pips so you understand better. Anyways, leverage lets you control larger positions with small capital, but magnifies losses too. Key truth is that you only make money by correctly predicting direction up or down. No dividends, no ownership, pure speculation. Simple, almost. This is simple. So, since I said currencies are traded in pairs, we have what we call major currency pairs. These are currency pairs which are very volatile, and there's a lot of money circulating from these currency pairs. That is why they are the major currency pairs. So we have, for example, the Euro USD, the Great British Pound to the United States dollar, the United States dollar to the Japanese yen, the Australian dollar to the United States dollar, the United States dollar to the Canadian dollar, the New Zealand dollar to the United States dollar, the United States dollar to the Swiss franc. And we proceed. One thing you need to know, guys, is that can you please avoid exotic pairs? Pairs like USD ZAR. Come on, do I even need to explain, guys? anyways, avoid trouble, okay? Yeah. So since I said the forex market operates 24 hours in a day, but you may ask yourself how, because in America it's night, in Europe it's day. The reason why it operates 24 hours in a day is because the market is traded in sessions. So there's different sessions. Understand? We have the Asian session, which starts operating from 12 midnight until 9 a.m. in the morning. And we have London session, which starts operating 9 a.m. until 6 in the evening. And we have the New York session, which starts operating from 2 in the afternoon until 11 at night. And the best session to participate in is London and New York, because there's a lot of volatility and there's a lot of liquidity circulating between those times, because we have people in Europe who are awake and they are injecting money into the market, as well as people in the US who are awake and they are injecting money into the market. Therefore, there's a lot of liquidity and a lot of volatility in the market during the overlap in London session and New York session. Anyways, before I start explaining, getting into the business of today, I haven't started. We are about to start. I hope you guys are taking notes. And if you want access to these notes, please, I'll leave the group to my Telegram in the description. You guys can access these notes for free on my Telegram group. Thank you very much. So the reality check. Forex is not easy money. Number one, statistics say that 80 to 90% of people who participate in this thing lose their money. But the question is, what if you make it to the 10% that actually makes money in this thing? But there's also a reason why 80 to 90% of people lose money in this market, and I'll show you guys why. You know what I'm saying? So success comes from understanding why prices move. So in order for you to understand or to gain success in this thing, you need to understand why there are certain fluctuations in the market as I move. So if you are new, if you are still learning, please use a demo. Don't risk real money when you don't even know when to buy, when to sell, why you buying, why you selling, and why is the market moving this way, where is the market going to. Just trade on a demo. Trust the process, trade on a demo. Once you're ready and once you've learned everything, then once you need to practice still. I'm not even going to say trade live. You need to practice and practice and practice and practice until you are perfect. Then fund your account and trade with real money. But because we're still learning, please trade on a demo. I am emphasizing this. I can never stress this enough. Please trade on a demo, guys. I said please. As we move, I'll come back to lot size and forex trading. In forex trading, I mean to say, I'm going to first explain what is a pip. Okay, a pip, short for percentage in point, is the smallest standardized price movement in a currency pair. It is how we measure how much the exchange rate has changed. So we measure the exchange rate using pips. Okay, plain and simple. I'm not going to over explain this. Most pairs, those without Japanese yen of course, A pip is usually the 4th decimal place, like as you can see on the example. For pairs involving the Japanese yen, a pip is the 2nd decimal place. It's demos. So, real examples of a typical 2026, whatever. Real examples are the Euro USD moves from 1.0850 to 1.0851. That is a +1 pip movement. So that movement from 1.0850 to 1.0851, we call that movement or that shift a pip movement, you know. So we're gonna say that price moved 1 pip. Yes, that is how we measure price. So pips are basically used to measure price or exchange rate rather. I'm going to show you guys an example of what pips are. So pips are these numbers at the far right of the chart. These numbers right here. These numbers are the pips. Those are pips, guys. Plain and simple. And as we move, many brokers now show an extra digit, you know. So the pips may differ depending on a broker, but it's not that difficult. It's not even a big issue even. It doesn't affect you in any way. As we move, why do pips matter? Pips matter, you know, because we use them to calculate profit and loss, and we use them to set our stop loss or take profit distance. And a 50 pip win on a small position or small trade might make 500 Rand. On a large one, much more. You know what I'm saying? So you understand that pips measure the exchange rate, plain and simple. Then how much is 1 pip worth in money? Let's get to the real shebang. So I said we'd go back to lot sizes. It's about time. Let's go back to lot sizes. So how much does 1 pip movement really equal to in money? Let's get to the money. So lot size in Forex trading. A lot size is the standardized unit that measures how much of a currency pair you are buying or selling in one trade. So a lot measures how much of that currency pair you are buying or selling. That is a lot size. And a pip measures the exchange rate of a currency. I hope you guys still remember and you are following. If you can't really, if I'm talking too fast, please rewind and feel free. You can always watch this video over and over again until you get what I'm saying. But I'm going to try my level best to explain this up to par. English is depleting. Anyways, in Forex, you don't trade €1 or $10. You trade these fixed packages called lots. These make everything consistent across the market. The reason why we trade in lot sizes and not just €1 or $1 and what is so that everything is consistent throughout the market. Because the foreign exchange market is not the only market in the financial market. We also have the stocks market, and we have the commodities market. We also have the bonds market, and so in order to make everything consistent throughout every market, we trade in lot sizes. And we move. So there's different types of lot sizes. We have the standard lot 1. We have the mini lot 0,1, and we have the micro lot lot 0,01. So the standard lot is units of base currency is 1,000 units. So if I'm going to buy the euro to the dollar using lot size 1, then it means I am buying 100 units of euros. I hope you guys are still following. It's gonna make sense. Nonetheless, I was still explaining the standard lot. So you make, for every pip move on a standard lot size, you make $10, meaning that if, for instance, let's say price moves and you have a buy right here and price moves let's say 60 pips, okay, and you have your trade, you're trading in lot size 1, lot 1, and for every lot you make $10. So to calculate your profit, if you bought here and let's say you took profit here at plus 60 pips, that means simply means that you made $600 in profit. Yes, so that's how lot sizes work. If you trade on the standard lot, because 1 pip move on the standard lot is equivalent to $10. And then we have the mini lot, which being 0.1. So when you trade on 0.1, it just simply means, let me just also, how much? It's $1. It says 0.1 means it just means you make, or you made $60 in profit. And we have the micro lot size, which is lot size 0.01. Same thing, guys, same thing. It is the same thing. This thing is not rocket science. I hope you guys are following and I hope you're taking down notes. 0.01, therefore making 10 cents, and therefore you make your profit being $6. So that is how lot sizes work. And standard lot sizes are good for large accounts, and I'm going to explain why. Let me just go back. The reason why standard lot sizes are good for large accounts is because, for example, let's say you have $30 in your account and you want to trade standard lot 1, and we have this being our price. We said this move was 60 pips. Yeah? And let's say you took your buy right here. And let's say you got out right here. Right here. At plus 60 pips. But because the market moves in zigzags, or rather the prices fluctuate, it's never just an uptrend move, wire. It is an up and down move, consisting of higher highs, higher lows, higher highs. So higher highs, what is a higher high? This is a higher high. This is a higher low. Higher high, higher low. This is the nature of the market. The market never just moves up. It moves in higher highs and higher lows. Okay? And you having your execution right here, and let's say you buy here and then price moves down, and this move down, let's say it is a young 5 pips. Let me just write it down here. 5 pips. This move down here is 5 pips. And for instance, you're trading lot size 1. Ne? Your lot 1. Mind you, you have $30 in your account. 1 lot is equal to $10. Understand? I mean, not 1 lot, but 1 pip move. And then this 5 pip move down here will cost you how much? Will cost you 5 times 10 being $50. This amount is larger than your account. You understand? So it means you cannot trade with a standard lot on this account. It is too small. It is definitely too small. I hope it makes sense. That is why I say that standard lot sizes are good for large accounts, because then let's say you are trading in not a $30 account, but let's say you are trading maybe a $300 account. Yeah. So now you're trading $300 account. Okay. You trading a $300 account, and same thing. Price moves 5 pips down. It is the same thing. That move down before that move up, because price moves that way. It is its nature. So hey, it is the nature of the markets. The markets are never just up trends, wire. They move in higher highs and higher lows, higher highs and higher lows. Okay. It is not to say your trade was wrong, because price does move in that nature. It is its nature. It will forever move like that. And let's say you're trading lot size 1, which 1 pip movement is equal to $10, and you have $60 in profit. Oh, before I get there, actually, let me not confuse you guys. We are here, Amos. I was explaining the 5 pip movement. The 5 pip movement, you'd be losing $50. And $50 here, you'd just be sitting at $250. You still have enough money to hold that trade until we get to the take profit at 60 pips, which then your profit would then be 1 times 60, which is the 1 times 60 is 60 most, times 10, because 1 pip is equal to $10. So then you'd be making $600. So this would be your profit. So which is why standard lot sizes are used, or good to use, when you have a large account, not just a small account. Excuse me. I hope I am making sense, and I hope you guys are taking notes, and I hope you are still following me. and remove. So that is basically how lot sizes work. Lot sizes measure your position, or they measure how much of the currency you are buying in units. You understand? So that is lot size. Like I did say, and I'm repeating again, if you want access to these notes, access is in the description. Click on my Telegram group and I'll post the notes there. Free, mahala, free 99. And we have what? A micro lot size. The concept is still the same, guys. It's still the same thing. And we have a nano lot size. So not a lot of brokers provide this one, but I know a broker that does, but they don't provide this one on currency pairs. They only provide it on synthetic indices. I know Deriv has nano lot sizes because I used to trade synthetic indices back then. I was trading both VIX 75, boom and crash, and wada wada. Yeah, these are the ones and twos, most. Remove. Now we're going to the real shebang. What is leverage? So you understand what is a pip? A pip measures the exchange rate. What is a lot size? A lot size measures how much of a currency pair you are bidding. And leverage. Now we are learning what is leverage. So leverage lets you control a much larger position or trade. A position is a trade, guys, so don't get confused. So leverage lets you control a much larger position than your actual account balance by borrowing from your broker. They don't really borrow you, but they borrow you in a way. I will explain why. So leverage is expressed in ratios like 1 to 100, 1 to 500. You understand? And a practical example, you have 10,000 Rand in your account. Your broker offers you a leverage of 1 is to 500. You understand? That means you can control up to 5 million worth of currency. You understand? So that is leverage, basically, guys. But in practicality, how leverage works. Leverage can work for you or against you, depending on how you use it. So I'm going to explain this in dollars. I don't even trade in rands either way. Okay. To explain leverage in practicality, so you guys understand better. I hope you guys are following, and I need you guys to be very attentive. Because if you miss me right here, you're going to miss me the whole entire time. So, for example, I'm going to use dollars because I don't even trade in rands. Damn this thing. Okay, there we go. So you have 10K in your account, okay? And the broker offers you a leverage of 1 to 500. Let me just zoom in. Damn this thing. Okay, 1 to 500. All right, that's your leverage. And let's say you use lot size. Let's see 3. Okay, which would just mean for every pip move you make $30. So without leverage, okay, let's just show this. Plus 60. Let's say you take a buy right here, and this smaller move here, let's call it 5 pips. Above. negative 5 pips. The smaller nyana move down here. Without leverage, I suppose you want to make 30 times 60, which would be 3,600. Okay, without leverage. And now if we factor leverage in, yeah, okay, I hope you guys can still see. If we factor leverage in, we're gonna say, because it's expressed in ratio, so to change from ratio to fractions, this is it. Why am I using a difficult number? But it's fine. I'm not in the mood to do maths right now, but for the sake of progression, this would now be 1/5 times 36/1 times 5 times 5. Now this would be 1 times I'm using my brain. I don't even have a calculator, but 30 times 5 is 150. 6 times 5 is 30. And 160 plus 30 is 180. Yakubo. Which is 180. Now, without leverage, this is the amount of money we'd be making. This one. Let me use a different color. This is the amount of money we'd be making without leverage. Okay? Now with leverage, still the same thing. We're gonna now take this 180. I'm gonna say 180. Yeah. Times 60. 60 being these pips, the move up was 60 pips, would now be equal to, guys, maths, I don't even have a calculator, Pela. So this is the amount of money you'd make with leverage. You understand? I'm gonna go through this again because I know there's someone who doesn't understand. Because bavele babona maths, babona ukuthi lo forex kuyashaya. This is simple, guys. You know that lot sizes, standard lot size, is calculated per pip. Okay, the movement per pip on a standard lot size is $10. Okay, and now I am using lot size 3. Okay, meaning that a standard or the exchange rate or a move, 1 pip, would be equal to $30. I hope you're still following. Without the leverage, the amount of money I'd be making would be 3,600. But because of leverage, I turned this ratio into a fraction and it gave us 180. Then we're going to take this 180 and then we're going to calculate the same as we did when we were calculating without the leverage. So that is the amount of money you'd be making. So let's calculate for this -5. If you say you open your position and you immediately go into losses and price moves down with 5 pips, how much would you be making? Or how much would you be losing, rather? You'd say 5 times 180 which would be equal to wrong. This number is too good to be true. So you'd be making a loss. Oh shit. So this small move here, this small move here, then the 5 pip move down would cost you $900. Imagine. But because you have $10,000 in your account, you are able to succumb to that loss. Your account is able to handle that loss. So leverage does not change your margin. It does not change the amount of money you have in your account. It just allows you to trade with a higher lot size. This is how you calculate leverage. And this is why I say leverage can make or break you, depending on how you use it. And let's proceed. Leverage is a double-edged sword. It magnifies both profits and losses. A small 20 to 30 pip move against you can wipe out your entire account if over leveraged, like I did show you guys. And margin call. Margin is the money you have in your account. If losses eat into your margin too much, the broker closes trades automatically. You lose everything. You blow your account, basically. And then in conclusion, pips is how we measure price changes. And leverage is how we control big trades with small money. Understand? So this brings us to the end of our lesson.